All right, so there is your conditional receipt. Hopefully that was helpful. Next, let's look at some disclosures at the point of sale. First, there are disclosure statements. Disclosure statements help applicants make more informed and educated decisions about their choice of insurance. Disclosure statement could be anything, kind of like a buyer's guide that we're going to talk about in a minute. Next, there's a disclosure authorization notice, which states the insurer's practice regarding the collection and use of personal information. The insurer just needs to know that their personal information is being gathered and then how can it be used, and just for underwriting purposes only. Next, HIV testing. Now, HIV testing, it's not against the law to do HIV testing. Usually for larger amounts of insurance is when an insurance company would do HIV testing. What you need to know for your test is who can have access to HIV test results. Well, if I'm the insured, I can, my doctor can, the insurance company can, and then the Department of Health and Human Services can. But I really want you to know who cannot have access, and that's why it's in your book, is anybody not involved in the underwriting process like other insurers. So other insurance companies cannot have access to HIV test results. Next, we have a buyer's guide. A buyer's guide is generic information. Explains how a buyer should go about choosing the amount and type of insurance to buy. A policy summary, which is going to be specific to a policy being issued. It will describe the features and elements of that policy. That could be anything like a brochure or possibly an illustration used in the sale of a permanent policy. Next, we have the USA Patriot Act and Anti-Money Laundering. After September 11th, 2001, Congress passed the Patriot Act. All financial institutions are subject to the Patriot Act, and since insurance companies take in premiums, they are considered a financial institution. So usually for any transactions in excess of $5,000, if the insurance company feels that transaction may be for an unlawful purpose, like they're being used to launder that money in any way, they would have to file what's called a Suspicious Activity Report, or SAR. All you need to know for your test is that suspicious activity reports have to be filed within a certain number of days, and you need to know that number, 30 days. But make sure you know these other words also. 30 days of initial discovery. Because if this one question comes up on your test, there will be two answers with 30 days in them. I need you to pick the one that says initial discovery. Let's move on to underwriting. Underwriting is the risk classification process. This is where an insurance company decides who they're going to do business with and how much they're going to charge them. That's why they have underwriters. The first thing an underwriter looks for when an application comes in is insurable interest. Now, insurable interest is where the policy owner must face the possibility of losing money or something of value in the event of loss. Insurable interest must exist between the policy owner and the insured at the time of application. However, it does not have to exist whenever a death benefit becomes payable. So this is important that you know that insurable interest has to exist between the policy owner and the insured, which means who has nothing to do with insurable interest. And hopefully you're thinking beneficiary. Okay, so make sure you know that the beneficiary has nothing to do with insurable interest. Three factors that may determine insurable interest are insuring his or her own life, insuring the life of a family member, relative, or spouse, or insuring the life of a business partner, key employee, or someone who has a financial obligation to them. And that would be like credit life insurance, which I will talk about in a later chapter. All right, so insurance companies gather our personal information. Where are they getting it from? Well, first will be the application. Remember, the application is the main source of underwriting. There's an agent report that gets completed by the agent. They could use that. They may require a paramedical exam. That's where a nurse comes out and draws blood. The results of a paramedical exam will give the insurance company your current health status. They may order your doctor records. That's called an attending physician statement. Or an APS, if they order your doctor records, that's going to give them your past health information. So make sure you know that paramedical exam is current health, where attending physician statement is past health. Next thing they will do is order a Medical Information Bureau report, or MIB report. What you need to know is the MIB was formed by insurance companies. It is made up of insurance companies. It is a nonprofit organization. That's where all of our information is kept. Anytime we apply for insurance, our applications are kept there. And anytime we use our insurance, the information is kept at the MIB. The whole reason insurance companies would get together and form the MIB is to help prevent what, do you think? Now, you might be thinking fraud at this point, but I have two new words for your insurance vocabulary. And those words are adverse selection. So adverse selection, my definition is sick people trying to commit fraud. Adverse selection is the insuring of risks that are of a poorer class or more prone to loss than the average risk. Because poorer risk or less desirable insureds tend to seek out and continue insurance coverage to a greater extent than better risk. So insurance companies got together and formed the MIB to help prevent adverse selection. Next, where they're going to gather some information are from some inspection reports. There are two we need to know for our test. First, there are consumer reports. Now, consumer reports are any written or oral information concerning a consumer's credit, character, reputation, and habits. And they get that information from employment records, credit reports, and other public sources. For your test, just think credit reports. That is a type of consumer report. Next, there are investigative consumer reports, basically the same thing, but they're going to take it a step further and they're going to go out and interview friends, associates, and neighbors of the consumer. There are two numbers associated with investigative consumer reports that you need to memorize. First, if an insurance company is going to do an investigative consumer report, the consumer must be notified within 3 days that the report is taking place. Then, if the consumer wants more information about what's contained in the report, they would have 5 days to get that to them. So just make sure you get your numbers down here, 3 days and 5 days for your test. Next, we have the Fair Credit Reporting Act. This is federal legislation. It established procedures that consumer reporting agencies must follow to ensure that records are confidential, accurate, relevant, and properly used. Also ensures against the circulation of inaccurate or obsolete information. That's why things have to fall off your credit report after a certain number of years because of the Fair Credit Reporting Act. Now, if you get declined because of information from one of your consumer reports, like a credit report, for instance, you don't go to the insurance company to dispute that information. You have to go to the reporting agency like Experian or Equifax. So you don't go to the insurance company, you go to the reporting agency to dispute any information. And then the maximum fine for violating the Fair Credit Reporting Act that you need to know for your test, and this is for the Experians of the world, is $2,500 for violating the Fair Credit Reporting Act. So make sure you know that number on Fair Credit Reporting Act, $2,500. Okay, now let's go on to insurance companies have gathered all your personal information. Now they're going to classify you. What type of risk are you to them? For your test, there are 4 categories. You're either a standard risk. A standard risk represents the majority of the people in your same class. For me, it'd be males, age, height, weight, avocation, occupation. Cover a standard rate. That's going to be the majority. Now, if I have a few health problems, like some high blood pressure or some diabetes, then I become a substandard. So sub means below standard. If I am a substandard risk, that means that the insurance company is going to rate me up. Remember back on our conditional receipt, if they rate me up because I was a smoker, or we had Jane who smoked pipes, she is a substandard risk. She's going to get rated up, which means they are issuing her policy with an amendment. Another name for that amendment is counteroffer. They've come back with a counteroffer, which means that the agent delivers the policy, which means that the agent has to have Jane sign a statement of good health, has to have her sign the amendment saying that she understands she's going to be paying more money, and then collect that extra money, and only then would coverage go into effect. Now, if you don't have any health problems at all and actually live a very healthy lifestyle, then you become a preferred risk to an insurance company. As a preferred risk, you actually pay a lower premium than a standard risk. Or you might have so many problems they could just decline you altogether. So those are your 4 categories of risk for your test. These next 2 policies are both really illegal. The first is called a stranger-originated life insurance policy, or a STOLI, and that is not vodka, people. A STOLI is where a person purchases a policy on somebody they don't know, a stranger, with the intent of selling it to a third party and profiting financially. Well, that doesn't sound very nice. Well, most states have outlawed this arrangement because it violates the concept of insurable interest. That person doesn't have insurable interest, they're just trying to make some money. Next is an investor-originated life insurance policy, or IOLI. Basically the same thing as a STOLI. You don't have to know the difference, but just know that it also violates the concept of insurable interest. So that's really all you need to know about these 2 policies, is they violate the concept of insurable interest. All right, we're on the home stretch here for this chapter. We're going to go into elements of a legal contract. We will use the acronym COAL, C-O-A-L. The first is the C here, which is consideration. Now, you learned in an earlier video, the word consideration means something of value that each party promises to the other. For the insured, their consideration or value is paying the premium, but also make sure you know it's the answers on the application. That's important. Okay, because how they represent themselves. So both their premium and the answers on the application. Consideration on the part of the insurer is promising to pay in the event of loss. Next, we have offer, and we're going to do offer and acceptance at the same time. The first offer is made by the applicant by completing the application and paying some premium, making an offer to the insurance company. Acceptance would occur when an underwriter would approve that prepaid application. Next, we have legal purpose. Once you get licensed, please do not go out and write up policies on people that are underage, high, drunk, not mentally competent to understand the contract, or all the above. Okay, they must be of age, not high, not drunk, and they must be mentally competent to understand the contract, or it might not be considered legal in a court of law. And then for life insurance to be considered legal, these 2 elements have to be there. Both insurable interest, remember the policy owner has to have insurable interest in the insured, but then they also have to have the consent of the insured to take out the policy. So both insurable interest and consent must be there. Next, we have some unique aspects of insurance contracts. Got 4 words for you here. First word is conditional, and these are just bulleted definitions, by the way. Conditional means certain conditions must be met by both parties. And then on these next 3 words, unilateral, adhesion, and aleatory, let me show you a quick video on each one of those to kind of drive it home. In this video, we'll define 3 words: unilateral, adhesion, and aleatory. Let's start with unilateral. Unit meaning one, only one of the parties is legally bound. As the insured, you don't make any legally binding promises. All you do is pay your premium to the insurance company every month. Now, let's say you don't pay your premium. Are they going to come after you legally at that point? Well, of course not. All that's going to happen is your policy will lapse and go away. Now, let's say that you have been paying your premium every month for the last few years, and then you suffer a loss. Well, since you've been paying your premium, now the insurer is legally bound to pay for that loss. So unilateral, only one of the parties is legally bound. And then our next word is adhesion.
Adhesion means take it or leave it. There are no negotiations in an insurance contract. So let's say you're the insured and your agent Jane just delivered your policy to you. Well, after looking it over, you're kind of confused and you're thinking to yourself, you know what? I don't think this is exactly what I wanted. And Jane, well, all she says is, I'm sorry. And so you think, you know what, Jane, how about if we negotiate this a little bit? Jane says, no, if you don't like it, don't take it. So adhesion, take it or leave it, there are no negotiations. And your last word is aleatory. Aleatory means unequal amounts are exchanged. So let's say you're the insured. You've been paying $100 a month for a life insurance policy from the insurance company with a $100,000 death benefit. Well, those amounts are kind of unequal, aren't they? So you pay a little to get a lot. So aleatory, unequal amounts are exchanged. So those are your 3 words for today, kids: unilateral, adhesion, and aleatory. See you on the next video.
All right, everybody. That is going to do it for this chapter over field underwriting. Now, go do some practice exams and let's see if the definitions have been memorized yet. We'll see you on the next video.